Have you noticed that the more investing information you consume, the messier it can feel? One day someone says AI stocks are impossible to ignore. The next day bonds look attractive. Then someone else says real estate is the only real inflation hedge. Every asset seems to be calling for your attention. But the real problem may not be that you lack the right pick. It may be that you lack an asset allocation map. Without a map, every new headline feels like a new direction. You may want to chase stocks today, switch to bonds tomorrow, and move money somewhere else the day after that. Many people start with the question, what should I buy now? But the earlier question is, what is this money for, when will I need it, and if it falls 30% in the short term, will my life be forced into a bad decision? If those questions are not answered first, even a good tool can become a source of stress when it sits in the wrong place. The same asset can mean very different things in different buckets. Buying with long-term money may be allocation. Buying with money you need next year may simply be gambling with time. That is why the task comes before the tool. So this video is not about which stock will rise next, or which asset class is always best. We will first divide money into 4 areas: the safety bucket, the goal bucket, the growth bucket, and the exploration bucket. This is not a fixed formula, and it is not a model everyone should copy. It is a way to give each dollar a clear location. The value of the 4 buckets is that your money stops being one mixed pile. Money for daily life, money for near-term goals, money for long-term growth, and money for experiments should each be managed with different rules. The first bucket is the safety bucket. Its job is not to earn the most. Its job is to keep you from being forced to sell investments when life surprises you. Losing a job, a family medical issue, a car repair, or an unexpected move usually does not wait for the market to be at a high. The safety bucket should prioritize liquidity and stability. It does not need to be exciting. It is more like an electrical fuse in your home. Most of the time you barely notice it, but when something goes wrong, it keeps the whole system from burning down. If the safety bucket is too thin, every market drop becomes a life problem. You may know rationally that long-term investing needs patience, but if your rent, tuition, or medical bill is waiting next month, you will not experience that drop as a long-term investor. You will experience it as pressure. This is why some people sell at the worst time even when they understand the theory. Their portfolio did not fail first, their bucket design failed first. A safety bucket is not conservative decoration. It is the part that buys you the right to think calmly. The second bucket is the goal bucket. This is money you may need in 1 to 3 years. A house down payment, tuition, a planned move, a wedding, a business deposit, or any clear future expense. The key is that the date matters. When a date matters, return cannot be the only goal. Availability matters too. If you need the money in 18 months, a temporary 30% drop is not just a chart movement. It can break the plan. For goal money, the question is not how high it might go. The question is whether the money will be there when the date arrives. The third bucket is the growth bucket. This is money you truly do not need for at least 5 years and ideally longer. Because the time horizon is longer, you can allow more volatility in exchange for long-term growth potential. This is where broad stock funds, diversified equity exposure, or other growth-oriented assets may make sense for some investors. The point is not that stocks always go up, and it is not that long-term investing has no risk. The point is that time changes what kind of risk you can reasonably carry. Money with time has more room to recover. But growth does not mean all in. A growth bucket still needs diversification, position sizing, and rules. If one hot theme takes over the whole bucket, then the bucket is no longer a long-term engine. It becomes a single bet wearing an investing costume. For many people, the boring part of investing is the part that does the most work. Recurring contributions, broad exposure, low unnecessary turnover, and the patience to let compounding breathe. The growth bucket should give your future self a chance, not make your current self addicted to excitement. The fourth bucket is the exploration bucket. This is the small area for high-risk ideas, new themes, single names, crypto assets, early-stage opportunities, or anything that could perform very well but also fail badly. The important rule is isolation. Exploration money should be sized so that if it goes wrong, your safety, goals, and core growth plan are not damaged. This bucket lets curiosity exist without letting curiosity take over the whole household. In other words, exploration can be useful, but it should not be allowed to pretend it is the foundation. After the buckets are clear, then we can talk about assets. Cash is like oxygen. It does not look impressive, but when you need it, nothing else replaces it. Bonds may help with stability or income, but they are not risk-free in every interest rate environment. Stocks can drive long-term growth, but they can also fall hard in the short term. Real estate can be a store of value or a cash flow asset, but it is concentrated and not always liquid. Crypto can be an exploration asset for some people, but it should not be confused with emergency money. The same asset becomes sensible or dangerous depending on its bucket. The order matters. First, protect daily life with a safety bucket. Second, protect known goals with money that is not forced to survive market timing. Third, build long-term growth with money that has enough time to accept volatility. Fourth, if your foundation is stable, keep a small exploration bucket for ideas that might be interesting but should never control the whole plan. This order is not about being afraid of risk. It is about placing risk where it belongs. A strong allocation map does not remove risk. It keeps risk from invading every corner of your life. For example, suppose a salaried worker can save about 20,000 Taiwan dollars a month. Without a map, that money may simply chase whatever topic is hot. With a map, the first part may refill emergency cash until the safety bucket is strong enough. The next part may go toward a gold bucket, such as a down payment or education fund. The long-term part may go into diversified growth assets. A smaller amount may enter an exploration bucket if the person has the risk capacity. The exact numbers are personal. The more important idea is that each dollar enters a mission before it enters a market. People often ask whether they should be conservative, balanced, or aggressive. But those words are not only about age. They are also about use, time horizon, income stability, debt level, family responsibility, and emotional tolerance. A young person with unstable income and no emergency cash may need a more careful foundation than an older person with a large safety bucket and no debt. The label is less important than the job of each bucket. The question is not, am I an aggressive investor? The better question is, which part of my money can responsibly take risk, and which part absolutely cannot? If you do not know where to start, ask 4 questions before buying anything. First, what is this money for? Second, when will I need it? Third, how much temporary loss can I truly tolerate without changing the rest of my life? Fourth, am I buying this because it fits the bucket, or because I am afraid of missing out? These questions do not guarantee a profit, but they can prevent many obvious mistakes. A bad decision often begins when money with one purpose is placed into an asset designed for a completely different purpose. The last piece is rebalancing. Over time, buckets drift. A market rally can make growth assets too large, a major expense can drain the safety bucket, a new goal can appear. Rebalancing means you review the map and return the portfolio to its purpose. This does not need to become daily trading. For many people, a quarterly or yearly review is enough. The goal is to ask, are my buckets still doing their jobs? If the answer is yes, you do not need to react to every market headline. If the answer is no, adjust the map before you adjust the tools. The conclusion is simple. You may not need more hot picks. You may need a clearer allocation map. First, build a safety bucket so life does not force bad timing. Second, protect money for near-term goals. Third, let long-term money work in a diversified growth bucket. Fourth, keep exploration small and isolated if you choose to have it. When the buckets are clear, assets become tools instead of distractions. Cash, bonds, stocks, real estate, and crypto all become easier to evaluate because each one has to answer the same question. What job is this money supposed to do?